So today, the electric vehicle startup Canoo, under the ticker HCAC, which is going public through a SPAC IPO, well, it had its big reveal of its new vehicle. But despite this, investors are not impressed and instead decided to sell the news. I'm here to tell you that they're wrong, and this is a much bigger deal than is currently being priced in right now. You see, Canoo's new vehicle can do a lot, and it's priced attractively. So immediately the first thing to address is that this is an electric vehicle, an electric utility vehicle. So it's not going to compare or look like a Tesla. But arguably the biggest bomb they dropped today is the price tag. For them to announce that this is going to be only $33,000 is a massive deal. And I want to help you understand and give perspective as to why that was such a big bomb for them to drop. What you have to realize is that that is the same price as another one of their competitors, Electric Last Mile Solutions, and their delivery vehicle. What's more is that actually, if you look at the presentation, the real price tag is $25,000, which is after a $7,500 tax credit. So this is a very big deal because this could become the work van of the future. And it's doing so by offering more utility at less cost compared to even established players like Ford, being priced 25% less than their 125-mile capable transit vehicle. So other than price, what is definitely clear from their announcement presentation today is that this is all about options. They want to emphasize how much customability there is. It can serve in multiple sites and for multiple applications, and again, for a lower price than their competition. And that influences the angle of sales approach that they're trying to push here as well. They're trying to make a very clear distinction and comparison versus trying to retrofit existing vehicle platforms. Because at the end of the day, they're still going to be the same delivery van. Whereas Canoo argues that they have an advantage being a clean, brand new platform, purpose-built for utility and purpose-designed to be an electric vehicle. It's very clear from other companies like Hyliion and Electric Last Mile Solutions that retrofitting is a lower-cost alternative transition process. But that doesn't mean it's not without complication or added cost down the road. And essentially, I feel over time, a truly purpose-built electric vehicle platform wins out in its ability to deliver functionality and return on investment, especially at this price point. And again, that price point favors very well versus the EV competition, as well as the already existing gasoline-powered vehicles on the road today. So if there's any criticisms I would have, it is around their production and manufacturing. Canoo is one of these companies that is looking to outsource their production, which helps them to not have the same sort of hurdles to overcome that companies like Nikola. They collapsed under the expectations and logistics necessary to build a factory and maintain it. So how Canoo is approaching manufacturing when they're outsourcing the production of their vehicles is that they're using a very unique and interesting way of doing this in what they call micro-manufacturing sites. And I think this is a growing trend among new EV startups, where a traditional factory will churn out hundreds of thousands of vehicles per year. A micro facility is a lot more targeted to something like 25,000 or 50,000 vehicles per year. But importantly, it takes less time and less capital to get it up to production-ready status, meaning that when Canoo says they'll be manufacturing in a year, in 2022, they really do mean it. And I think as affirmation of that, one of the most popular EV startups right now is Arrival. And this is a manufacturing strategy they're using as well. Both companies are looking to minimize the upfront costs and the production time, and are looking to evangelize the benefits of electric commercial vehicles to the respective industries that will use them. Not only that, I think for the next couple of years, it's going to be much easier to sell commercial electric vehicles because businesses get the benefits of EVs, and they're more likely to use them for last mile solutions, such as in a delivery vehicle or utility vehicle example. It's going to be much harder to convince the general public that EVs are the future, and it's going to require things like price parity to gasoline-powered vehicles for them to start being convinced by the benefits of EVs. That change will come, but in the meantime, startups that are focusing on commercial vehicles, I think they're going to have the head start. And as far as I'm concerned, it's a much bluer ocean opportunity. So the vote for Canoo and HCAC happens on December 21st. And with the stock trading at around $19 today, I don't think there's any chance the deal will be voted down. Once the deal goes through, the stock ticker will change from HCAC to GOEV. So I expect Canoo to continue to do very well into its IPO and beyond. But remember that SPACs are momentum plays and that there will likely be a sell-off once they complete the IPO, as is pretty common with SPAC IPOs. However, that doesn't discount the overall long-term likely winning play that Canoo is shaping up to be. So I'm excited to see where they go from here and if they truly become a market and industry leader. But I want to hear what you think. Do you think HCAC and Canoo are really good targets right now? Or do you think it's time to sell them, wait for the dip, or go chase another EV stock? Let's discuss in the comments below. But before you go, don't forget to join the 10X Tribe, our free community all about taking your trading to the next level. We share opportunities every day. We have free education, and it's a great way to make sure that you end your 2020 with a beginning. So I'll see you there. The link is in the bio below. But until the next one, thanks so much for watching. Take care out there. Cheers.